Welcome to Market Catalyst. I'm Julie Hyman. We are 30 minutes into the U.S. trading day. Let's get to the three market catalysts we're watching this hour. First up, a government shutdown looms in Washington. We'll break down the implications for the economy and for investors. Plus, we'll push ahead to the September jobs report due out at the end of the week. And EA strikes a $55 billion deal to go private. We'll discuss that and much more on Market Catalyst. Well, let's first start with the major averages and what we're seeing in the markets today. We started strong out of the gate, but the Dow has already slipped into the red. It's off by about 19 points right now. The other major averages are still hanging on to gains, but they're lower than they would have seen than what we saw in early trading. The S&P is up 0.4%. The Nasdaq is leading here, up about 0.8%. And if you look at what's under the hood here in the major averages, you've got energy and utilities that are sort of dragging on the majors and on the S&P 500 in particular. Tech and sort of cyclicals like industrial to continue to be strong here. The XLK Tech, XLC Communications Services. The NASDAQ, as we know, ran into some speed bumps last week. Some questions about the sustainability of the AI rally, about the spending and what's funding that spending coming to the fore. But this morning we see strength in particular for NVIDIA. Those shares up 2.5% here at the moment. And just to quickly look at a 3-month chart here, looking at NVIDIA through the course of the quarter. We're coming up on the end of the third quarter, of course. And basically, we've seen an upward move at the beginning and then largely sideways movement, which is true of some of the other AI-related names as all. But a decent amount of green on the screen here today as we track the early action. Let's broaden it out here this morning and talk about what's going on this week. Lots of economic data on tap for the week, including JOLTS, ADP, culminating in the September non-farm payrolls report. That's set to be released Friday, although that could be delayed if the government shuts down. According to consensus, the U.S. economy is expected to add 50,000 jobs in the past month, with Bank of America expecting 65,000 jobs to be added. And joining me now is someone from Bank of America. That's Stephen Juneau, Bank of America Securities U.S. economist. Stephen, it's good to see you. My colleague Brian Sozzi was just speaking with Joe Livornia, who is an economic advisor to Treasury Secretary Scott Bessent, formerly on your side of the of things as an economist at various Wall Street institutions. And he said that the administration sees this job market as not remaining weak, but he says the Fed needs to cut rates. What is your take on that? How would you characterize the job market right now?
I think not weak it's somewhat right. I mean, we're in kind of this low hiring environment, but I think there's a lot of reasons to expect a little bit of a broadening out, as Joe Livornia said earlier, amongst kind of where we see hiring coming from. And why is that? I think it's because you're actually seeing very resilient consumer spending. We got a strong upward revision to GDP last week in the second quarter, and that was due to better consumer spending than what we had expected previously. We're seeing uncertainty clear on the policy front. That should help businesses kind of look into hiring decisions, kind of think about what their plans are for the years ahead. And that can lead to kind of more broadening out. Whereas right now, what you're seeing in the labor market is definitely some softness, and it's really concentrated where hiring is just in one sector, just healthcare. But I do think if we continue to see this resiliency in the economy, which is our base case, and we do think we'll see a little bit of a reacceleration, then you can see some broadening out to other sectors where non-farm payroll starts to pick up a little bit from here.
That said, Stephen, there's been some talk that cutting rates is not necessarily the thing that's going to transmit to more job growth. Do you think that that's right?
So I do think you're not necessarily going to see this huge amount of stimulus from the Fed cutting rates where market's currently pricing. Why is that? Well, 10-year rates are still at 4.1, around a little bit above 4%. And that's really not going to all of a sudden trigger a lot of investment in non-residential structures. It's not going to free up the housing market, which remains kind of locked into place. So you're not all of a sudden going to turn around those sectors unless the Fed maybe cuts a little bit more aggressively. But if they were to do that, then it would probably be for bad economic reasons and reflective of weaker economic conditions than what we're seeing now. So I would agree with that. You're not going to see just interest rates all of a sudden lead to a surge, but we have to remember you have some expansionary fiscal policy. If you get a little favorable interest rates policy to where interest rates are moving lower, then that will help the fiscal policy prove to be more stimulative. And then, of course, if you see this resiliency in the economy emerge and we have this fading uncertainty, then that too will help the economy look a little bit better and have better job growth.
We had Beth Hammack this morning speaking at a conference in Europe, and she says she is still concerned about inflation. How concerned are you about inflation? And, we have some more tariffs taking effect this week. The president announcing yet more tariffs to come on places like the movie business this morning. How are you thinking about that? And why do you think we have not seen more of that tariff impact on inflation?
Yeah, so I think we have seen it. It's just not that we've seen a one-to-one pass-through to the consumer. So for now, businesses are really absorbing some of the costs, and some of that was probably due to the uncertainty about where tariffs would land. I think now that we have that clarity, give or take maybe a few percentage points, there's still some sectors, as you mentioned, furniture, heavy-duty trucks, right, where you might see further tariffs be implemented. But now you're kind of at a floor of around 15%. So now you know that. And that will allow you to kind of think about what your pricing can be set at. And so you should see more pass-through coming in the pipeline. And I do think Governor Hammack is correct, and the Fed should still be worried about the upside risk to inflation currently in the pipeline right now, currently that the economy is facing. We think inflation will remain above, say, 3% for the next 3 quarters. So that's something where the Fed continues to miss their target. But it's not something where we're going to see a huge spike all of a sudden. We're not all of a sudden going to hit, say, 5% on inflation. It's more a period of above target inflation, and that risk a de-anchoring of inflation expectations, which would be the most problematic scenario for the Fed.
And Stephen, let's zoom in on the economic releases we're getting this week, particularly JOLTS and then non-farm payrolls. What are you going to be paying attention to in particular? Is it going to be, for example, signs of that broadening that you're talking about?
Yeah, that would obviously be good to see. I mean, I think on the flip side, so, what we're looking at now is for the labor market, is the weakness on hiring, on payrolls, is that more a labor supply issue, which we think it mostly is, or is it labor demand? Now, out of JOLTS, we get good data on labor demand. So if we see a further decline in the job openings rate, we would be a little bit more concerned about the state of the labor market. So we'll be watching that obviously closely. Then in addition to that, I think the ratios are really the best. The quits rate, the hiring rate, the layoff rate, those give a better overall picture for the state of the labor market. So we'll be watching those closely. And the quits rate has been low, the layoff rate has been low, and the hiring rate has been low, right? So these are the things that we're just looking to see. Do we see that layoff rate tick up? Do we see the quit rate remain low? That's indicative of a softer labor market. And do we see job openings come down? Then when it comes to the jobs report, I think the unemployment rate's the best measure. We're expecting it to hold at 4.3%, just because the unemployment rate is going to capture that labor demand and labor supply effect all at once. So we're going to key in on that, and obviously wage growth too. So we've seen wages kind of gradually cooling off of late, but if they cool off more dramatically or if they stabilize, I think that's a better indication for the state of the labor market than just looking purely at payrolls. So we're trying to basically look at the data that really captures demand and supply, and that's why we like the unemployment rate, wages, and then I would say job openings, job openings rate on JOLTS.
And Stephen, of course, there's a bit of a conundrum here because we may not get the non-farm payrolls report or the unemployment rate on Friday. If there is a government shutdown, that report could potentially be delayed. I've talked to some economists who say, well, if that happens, then you got to pay more attention to the private data, i.e. ADP and others. In the past, though, people have sort of questioned the quality of ADP versus the quality of the government data. So as an economist, how do you approach that going forward?
Yeah, I mean, I think you got to work with what you have ultimately, So unfortunately, in this situation, if you don't have the jobs report before the Fed meeting, and this is very important, if we get a brief shutdown, there should be enough time to where we still get the jobs data, we still get the inflation data. We have to remember the Fed meeting is at the end of the month. And we saw in 2013 that we had basically a 2-week shutdown, and that data was released shortly after. So the Fed could be still working with the full data set. But I think in the near term, right, you have to basically use your best alternative available. And I would say ADP is a good alternative at this point in time. It's a very rich sample. It really is just giving you a report of what their own data is showing. Tracking non-farm payrolls very well.
Stephen, thank you so much. It's great to see you.
Thanks for having me on.
Coming up, we'll have more on the economic ripple effects of a potential government shutdown. Plus, we'll get 2 analyst takes on EA's decision to go private. That's next on Market Catalysts. A government shutdown is looming once again. President Trump is meeting with top congressional leaders today as current federal funding is set to expire tomorrow. The bill on the table now would only fund the government through mid-November, and it must pass before October 1st to avoid a shutdown. Joining me now on this is Shai Akabis, Bipartisan Policy Center Director of Economic Policy. Shai, it's good to see you. So here we are again with this situation. I guess one of the advantages of having gone through this before is we sort of know what to expect in terms of the economic impact. You know, we can kind of game it out depending on how long it lasts. So what do we know? What do we need to watch as this unfolds?
Yeah, so some parts of our country are known for producing cars or soybeans. In Washington, we're known for producing 11th hour budget drama, and we're here again. As you said, we've seen this play out before, and we know generally what the consequences look like as the government shuts down. It's inefficient, it's costly, it's inconvenient for many businesses and consumers across the country. You know, this is going to be the 29th out of the last 29 years that Congress has failed to get its budget done on time. If nothing else, this demonstrates that the budget process is fundamentally broken. We've known about both the deadline to fund our government, October 1st, the start of the fiscal year, and the expiration of these enhanced healthcare tax credits, the ACA credits, for a long, long time. And Congress has not acted yet. And now here we are again with less than 48 hours left and going into the brink of a government shutdown.
So what's the potential economic cost here as we, if indeed this does happen?
So it's hard to know exactly because part of it will depend on exactly what the plans look like for shutting down the government. Those are called contingency plans that each agency is supposed to put out well in advance of the shutdown so that both the employees who work at those agencies and everybody else in the economy who works with them knows what that will look like. This time around, they've actually been very delayed in putting out those plans. So some of them have been trickling out over the weekend, this morning, and we have yet to digest exactly what that looks like. But roughly, what we've seen in the past is that short government shutdowns are just inefficient, don't have a large effect on the economy. When it drags on, like the one in 2018 and 2019 did, that one lasted 34 days, then it can really start to materially have an economic impact. That one was estimated to have cost at least $3 billion to our national GDP. That's not overwhelming. It's not going to by itself throw us into a recession, but it is costly. It is something that we really need to try to avoid. And unfortunately, it's a pattern that we've gotten ourselves into.
Shai, what do you make of the administration's threat that maybe some of these furloughs would become permanent? Would that, on the one hand, have a positive effect on spending? How do you think about that?
There's lots of ways that we can go about improving the federal budget, the fiscal status of the federal budget. Shutting down the government is not one of them. It never results in budget savings. The only way to produce budget savings is for Congress to enact those savings and the president to execute them. And what we get with the government shutdown is actually the opposite. We are paying government employees not to work because the government sends, in the past, roughly 40% of its employees home. They get furloughed, and they are ultimately back paid, but not doing the work of the federal government of the American people while the government shutdown is going. So it's not an effective way to cut costs. There is lots of waste and inefficiency in the federal government, and we should be looking on a bipartisan basis to cut that down. But doing so on the brink of a shutdown or during a shutdown is not the ideal way to go about that in a manner that's going to produce the intended results.
Well, but Shai, I mean, this time they're saying they're not just going to furlough some of these folks. They're going to say, don't come back, right? I mean, so how seriously do they take that threat, and then what effect does that have?
Yeah, so the fact of the matter is we've already seen significant changes to the federal workforce over the last 9 months or so. You know, we've had about 300,000 federal employees that as of the end of this fiscal year will no longer be with the federal government relative to before. And so, sure, it's possible that the executive branch, as they've indicated, may try to take additional action and lay off additional employees during a shutdown. That would not be the practice in the past, and I think it's questionable whether that is legal. I'm not a lawyer, so we'll not weigh in on that. But if that happens, yes, it could further hamper government operations depending on how those cuts are made, and obviously it will affect the employees that are impacted. But more broadly, I think we need to be considering the impacts that will happen across the United States. Most federal employees do not work in Washington. Most of them are in communities across the country, and both them, the contractors that work with them, and then the communities, the businesses that rely on those employees. So if you have a small business in a federal office building or right next to a federal office building, if none of those employees are coming in, then the business isn't making any money. State and local governments, a lot of them rely on the federal government for the services that they provide. And if there's an extended shutdown, then they have difficulty providing those services. So there's lots of effects that trickle out throughout the economy. And the quicker that the two parties can come together and reach a deal, the better it will be for everyone.
You started off by saying this is the 29th of 29 years that we have gone through this, Shai. How do we keep this from happening?
Yeah. So we find ourselves here because both of our political differences and the sort of broken down functioning of our ability to govern and budget, and also the fact that we have an enormous federal debt burden, which has sort of paralyzed our ability to deal with it. We don't have a functioning process where we address revenues, address spending in a coherent manner in bipartisan negotiations. And so what tends to happen is the only moment for a pressure point is something like a government shutdown or a debt limit potential default. That's extremely risky, extremely inefficient, and we need to find a better way. If we don't resolve our political differences, no process by itself is going to force the two parties to work together. So ultimately, we need both of them to be working in the interest of the American people, come to the table and find agreement that can both keep the government open and address other important priorities like healthcare costs.
Shai, thanks so much. Appreciate your perspective.
Thanks for having me.
Electronic Arts is going private. The video game company agreeing to be acquired by PIF, Silver Lake, and Affinity Partners in an all-cash deal worth $55 billion. Joining me now, Andrew Marek, Raymond James analyst, as well as Michael Pachter, Wedbush Securities Managing Director for Strategic Planning. Guys, thanks for being here. I want to start sort of with the basics here. The premium that is being paid in this deal for EA, 25%. Andrew, I'll go to you. Is that premium too high? What do you think?
I think now that we've had some clarity and the ability to run some numbers on this one, the price paid actually does appear fair, given some precedent in things like the Microsoft and Activision Blizzard transaction, which commenced in 2022 and finished in 23. Looking at things like the trading multiples between those two companies, somewhat similar in terms of trading dynamics. EA a little bit more consistent, Activision a little bit more hit-driven. But when you're talking about the two biggest scaled, formerly independent publishers in the U.S., you know, the trading multiples, the LBO models, the implied value all seems to make sense.
Michael, do you think anybody's going to come in and bid for this thing?
Zero chance of that. Yeah, I mean, unless it was a management buyout, but obviously management's part of this deal. No, nobody's got that much money. Andrew's right that the premium is reasonable, but it's not cheap. So it's not like they're offering $100 billion and somebody to come in at 150. This is rich. You need to make, at least $2-3 billion to justify a U.S. Treasury kind of multiple. So clearly the Saudis have some plans to expand the portfolio. I think the Saudis are looking forward 50 years, not 5, and are thinking about connected TV games. They're thinking about how EA just absolutely sucks at mobile, and they have two of the best mobile companies already in their portfolio with Niantic and Scopely. Brand extension into mobile, EA is going about it the wrong way, so I think the Saudis can fix that. I'm not sure they can fix it while they keep Andrew Wilson in place, but perhaps eventually he retires at 50 and they put somebody in there who really tries to exploit the portfolio.
Interesting. And for those who are not familiar, PIF, which we referred to earlier, is indeed Saudi Arabia's public investment fund. So that's who Michael's talking about there. Andrew, what do you think? What kind of changes now need to happen? I mean, EA, has obviously been struggling a little bit. They came out with those disappointing net bookings a couple of months ago. So what needs to change under this new structure?
It's actually interesting. We've written about this, that some of the things that we thought needed to change, it looked like they were starting to change. You had some evidence of EA kind of centering the player's voice, I think, a little bit more in things like the turnaround of EAFC 25, where they really honed in on the core competitive player and what their specific concerns with the game were. And kind of most obviously in the Battlefield 6 development process, where they had the Battlefield Labs testing environment, which was kind of an ongoing iterative feedback process between the developers and the players. I think Michael made some great points on things like the mobile business, which EA has great IP that they've never been able to exploit on the platform. and certain launch issues around non-sports titles especially certainly need to, I think, can be cleared up. But overall, I think they've done a decent job at some of their bread and butter, which are things like the sports games, and now starting to listen to the player a bit more.
Guys, taking a step back here, some of what you talked about are sort of EA specific, but I'm looking at an industry now in the US that is only going to have one independent, publicly traded video game publisher, right, in the form of Take-Two. Like, Michael, what is it about this business that we've seen this consolidation and, these changes where you don't have that independent ownership anymore?
I think it's two things. I think investors have given up on the space and have concluded, I believe wrongly, that it's not growing. And the truth is that mobile's still growing, maybe single digit, but 6, 7, 8% on a $150 billion base. Console PC maybe not growing as much, and investors don't understand that connected TV is coming. I think that the big public companies have kind of proven that they don't understand mobile. So Activision bought it when they bought King, and Take-Two bought it when they bought Zynga. EA made 3 bad acquisitions. They bought Glue and this Golf Clash game, and I forgot Codemasters. They're just terrible. So I think EA is being put out of its misery. But big corporate and big investors are in a position to take the risk that retail and institutional investors are not. So we're seeing consolidation because the guys with a vision for where the industry is going have the money. And retail investors, unfortunately, have to rely on guys like Andrew and me to tell them what to do, and they stopped listening years ago.
So, Andrew, what do you do? I mean, do you buy Take-Two because it's the only one left?
Take-Two and Roblox are 2 companies that we get a lot of investor interest on. Obviously, Roblox not a publisher or a content owner in the same way that EA or Take-Two were, but there are still interesting stories to be told in the industry. I think Roblox particularly taking a unique approach to how they're choosing to crack the nut of gaming engagement. And of course, Take-Two will be interesting to investors into and through likely the release of Grand Theft Auto 6 in May 2026, which is likely going to be by some distance the biggest launch in video gaming history. So there's less out there, but I think there's still enough to be interesting here in the short term.
And Michael, is there also a case to be made that you buy the bigger conglomerates? That do you buy a Microsoft for Activision? Do you buy a Sony? How should people be thinking about that?
Sony for sure not. Sony's a terrible company,
okay.
and they actually are blowing it in the games business. Look, games are moving to connected TV. So think about all the participants that are going to deliver games the way we get movies via Netflix. And forget the subscription model. Just think about iOS becoming on your TV. So free-to-play games on your TV. Who's going to deliver that? Cloud providers, AI. Anybody who's investing in making that happen is where you want to be. As far as remaining publishers to invest in, full disclosure, I own 500,000 shares of Playtika. And I didn't buy it by accident. It is trading at about a 4.5 multiple. If it gets an EA multiple, I'm going to make several $1 million. I think that's the one, and that's where I put my money where my mouth is. It's a great company. They are big in mobile, and they're actually beginning to grow again and deliver lots of profit. So that's my favorite, and I'm talking my book.
I got to ask you, Michael, when did you buy that one?
Between July and now. I've been nibbling at the lows, and I love that thing. And it pays an 11% dividend, so you get paid while you wait. I think this thing is a 5-bagger. I wouldn't have put that much of my personal wealth in, but what the hell? I'm a risk taker, so I suggest that your viewers do the same.
Well, the stock so far has not done well, but as you say, if it is at the bottom, I guess it's a good bet. We'll talk more about it another time. Andrew, Michael, great to see you guys as always. Really appreciate it.
Thank you.
Pleasure.
We got much more markets action coming up. Stay tuned. You're watching Market Catalyst.
Welcome back to Yahoo Finance. I'm Allie Canal, live at the NASDAQ. Let's turn now to some of today's top analyst calls on Wall Street. First up, Morgan Stanley turning more bullish on the big banks. The firm raised price targets for large U.S. banks by a median 14%, setting street highs for Bank of America, Citi, and State Street, while downgrading Wells Fargo and U.S. Bancorp to equal weight from overweight. Analysts said they're rolling their valuation year forward to 2027, expecting M&A and capital markets activity to return to long-term averages as rate cuts support loan demand. New targets include $66 for Bank of America, $129 for Citi, $162 for State Street, and $854 for Goldman Sachs. Morgan Stanley also upgraded mid-cap lenders to attractive, pointing to a stronger backdrop as the yield curve steepens. Next up, shares of Electronic Arts jumping after confirming a deal to go private. Silver Lake Partners, Saudi Arabia's public investment fund, and Affinity Partners, which is run by President Trump's son-in-law Jared Kushner, will acquire EA for $210 a share, valuing the company at about $55 billion. The deal is expected to close in early 2027, pending shareholder approval, with CEO Andrew Wilson staying on. Ahead of the announcement, Wedbush downgraded EA to neutral from outperform and set a $200 price target, roughly reflecting the deal value. Analyst Elisa Reish noted that the downgrade is a reflection of limited upside now that a buyout appears likely. She still sees fiscal 2026 as a pivotal year, with Battlefield expected to drive growth and margins higher, but says that going private could help EA build out its mobile business and live service revenue. Finally, Comcast shares in focus after Bank of America cut its price target to $36 and kept a neutral rating. The firm now expects broadband losses of about 120,000. That's slightly better than its previous estimate, helped by seasonality and mobile growth. Media earnings should also get a lift from the timing of Peacock's NFL game, while Parks revenue remains pressured as Epic Universe ramps up. Separately, Comcast named Mike Cavanaugh as co-CEO of the company. He's set to join longtime chief Brian Roberts. We'll keep it right here on Yahoo Finance. We'll be tracking all the market moves throughout the session.
Now time for some of today's trending tickers. We're watching media stocks, Beyond Meat, and Kroger and DoorDash. First up, we got media stocks. We're watching the sector as President Trump threatens 100% tariffs on any movies made outside of the U.S. He first floated the idea on tariffing foreign films in May, causing shares in U.S. media giants at the time, like Netflix and Warner Brothers and Disney, to slump. The untested idea received strong pushback from the entertainment industry. It's not clear how such a tariff would work, nor how films would be valued for duty collection purposes. Those shares are mixed today. Next up, Beyond Meat. The plant-based meat producer plunging after making debt holders an offer that will erase more than $800 million of debt, but also most of the stock's value. 47% of the company's convertible note holders have already agreed to replace them with new bonds and common stock known as payment in kind. That means Beyond Meat will be able to pay interest with additional debt rather than in cash. The company is now asking other creditors to take up the offer. The proposition comes as Beyond Meat grapples with weakening consumer demand for plant-based meat alternatives in the U.S. Finally, DoorDash and Kroger, the delivery app and grocery store, are expanding their partnership. Starting this week, DoorDash will offer delivery from Kroger's 2,700 U.S. stores. Since 2022, DoorDash was delivering sushi from 900 Kroger stores and flowers from 1,700 of them. But starting October 1st, Kroger's full assortment will be available to DoorDash customers. Both of those stocks higher. DoorDash by more. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. Coming up, much more markets action, including a deep dive into the FX market. You're watching Market Catalysts.
GLP-1 is in a transitional stage with new innovations in the works such as oral formulations of weight loss drugs. Eli Lilly and Novo Nordisk dominating the GLP-1 space, but Amgen making its move as the company says it has started two critical late-stage trials for its weight loss drug. For more on the weight loss market, let's get to Citi Research Managing Director Jeff Meacham. Jeff, it is great to see you. Maybe start big picture for us, Jeff. I'm curious what the Citi house view is of how big, Jeff, you think the GLP-1 market could eventually become. I see some estimates out there, Jeff, $100 billion annually within the next decade, but I'm curious to get your thoughts, how big you think the market could become eventually. What are the variables that depends on?
Yeah. Thanks for having me, first of all. Yeah, and great question. I think we can get to $100 billion. I mean, it could easily be by the end of the decade, so you don't even have to wait, really more than 5 years or so. The limiting step here is there's two things. One is how big could these drugs be outside the U.S. right now? a patient on one of the GLP-1s for obesity still has to have, for example, comorbidities. But Lilly's drug, which you mentioned, the oral drug, if that becomes a consumer-driven drug, then that could be a big deal with maybe more out-of-pocket costs. And then I think it's just expansion of the indications. So not just diabetes or obesity, but into cardiovascular disease, into maybe inflammation. These drugs do more than just cause weight loss. They cause, for example, lower blood pressure, lower lipids. So there's a totality of a benefit that I think the category, I feel like, has a lot of innovation and a lot of growth still left, for sure.
How well, Jeff, do these drugs work? I ask because you have so many headlines and reports and studies. It's tough to keep up. I mean, weight loss, but then you have concerns about muscle loss that are out there. What do we know?
So what we know is, between Novo and Eli Lilly, the drugs, the injectable drugs, and it's a simple once-a-week injection. It's with a pen, subcutaneous, very, very much painless. At the low end, it's something like 12 or 13%. At the upper end, it's 20%. And that's the data, and that's probably the real-world experience as well. It could be, it's not going to be much more than 20. The oral drugs are maybe slightly less potent, we'll call it 10 to 12%. But the key thing here is that these drugs are very well tolerated. That is, I think, one of the bigger, concerns for investors and really in patients is, nausea, vomiting, diarrhea, a lot of the GI side effects. Is that going to be kind of a deal breaker when you think about how long a patient could be on these drugs? As it turns out, in the real world, they're better. They're better than what we saw in clinical trials. Patients start off at a very low dose and kind of work their way up the titration curve to a higher dose, and then you can get to teens, mid to high teens weight loss without really much of an issue, I think.
And when do the pills officially hit the market, Jeff? Is that next year? And do we have any line of sight on pricing there?
Yeah, so officially, Lilly, if they take one path, it's a traditional path, accelerated approval. It'll put it on the market, maybe next summer. There is a path that the Trump administration has established with the FDA that could lead to, I say could because that's not the investor expectation, it could lead to a 1 to 2 month review cycle. So I don't know, I would call it maybe a 1 in 4, 1 in 3 chance that it could be available, the pill could be available this fall, November, December. That would be remarkable if you had that fast of review. But either way, though, I think most investors are thinking about next year, middle part of next year as being the first availability. And
I know, Jeff, I think you mentioned Lilly. I think you're buy rated on Lilly. What about Amgen, though? How do they stack up? How do they compare and contrast?
So if you think about Amgen in this context, my guess is at the end of the decade, it'll probably still remain a Lilly and a Novo, domination. I mean, it's probably 90% of the share will be those two companies. The remaining share, the jury's still out, but Amgen, I think, is given the prize of maybe the third company to the space because, as you mentioned, they're in a bunch of phase 3s. The differentiation of their drug, Maritide, is that it has, very competitive weight loss. The tolerability hasn't been as competitive, but it could have a longer acting, mechanism. So every 2 months or every 3 months type of injection, as opposed to a once a week. And I think that appeals, I think, to a lot of patients. And so, but we still have to see how that looks in phase 3. The phase 2, I think, are de-risking in that they, the drug works and was sufficient enough to go to a pivotal study. But whether that's going to be competitive with Novo and Lilly over time, we'll have to see.
Finally, Jeff, while I have you, we did have the president post on social media. He called these new levies on pharmaceuticals. How, if at all, Jeff, walk me through how you think that could impact your coverage universe.
Yeah, it's interesting. I mean, the pharma tariffs have been a big part of the conversation in big cap biotech and pharma, really for this entire year. There's not a lot new to the conversation other than, I think it's just a public negotiation. That's kind of what Trump did last night. And it's what he's done all year is, trying to pry companies to make sure that they build manufacturing and all stages of manufacturing plants from the API to fill finish facilities in the U.S. And so bring jobs, bring manufacturing, skills here. So I think the tariffs, most companies have been fairly I would say less willing to make a bold call other than, yes, we're going to build manufacturing, and yes, we have some offsets to tariffs if that does play out. But I feel like, there's been a lot of anxiety that's been related to like the public negotiation, which is kind of President Trump's style. But I think it's still, it's still TBD whether these are really going to play out in this fall or next year. The companies have the margin, though, I think, to pay the tariffs. The question is, like, what's the end user rate going to be per company?
Jeff, great to have you on the show today.
The U.S. dollar moving lower as a potential government shutdown looms over markets. So what are the pros and cons of a lower dollar? Which currencies are poised to show strength the rest of this year going into 2026? Let's bring in Jane Foley, Rabobank head of FX strategy. Jane, it's good to see you. So as we look at the dollar, the backdrop of the shutdown, it seems to me that in the view of a lot of FX strategists, the outlook for the dollar already wasn't great. And then you put this shutdown layer on top of it. So let's take the shutdown itself first here. Talk to me about the implications for the U.S. currency.
Well, to be honest, we've had plenty of threats or imminent government shutdowns in years, in the last few years, and they don't all knock the dollar at all. Now, this year, perhaps it's a little bit different because the market has been debating as to whether or not the dollar's safe haven status has been undermined in some way by Trump's policies. Now, that is not our view. We still firmly believe that the dollar is a safe haven currency and that the rotation out of the dollar in the first 5 months or so of the year was really more to do with positioning a really long bout of people building up long dollar positions over a period of years. Now, what's interesting, I think, right now is despite that uptrend in euro dollar this year, we haven't spent an awful lot of time above 118. And yes, the dollar is weaker today, but that's because it actually was strong last week. So I think this is just, or at least the reaction that we've had today is just a bounce back of euro dollar from the decline that we had last week. And I'm not convinced that the shutdown or the imminent shutdown or the possible shutdown of the US government will really knock the dollar that much at all.
So let's talk about then the more fundamental backdrop here. And I know you're very closely watching the issue of who is the next Fed chairman and whether that chairman is independent. How does that then feed into the dollar?
Well, if you think about what is priced into the dollar in terms of Fed easing, well, there's a lot. And certainly last week when we had that stronger than expected US GDP revision, that really did invigorate that debate that is out there as to whether or not the US economy could even rebound next year. Now, if we go back perhaps to April or so, just a few months ago, the market was fairly inclined towards the view that the US could be falling into recession. Now, that view, or at least the recession word, really has diminished. And yes, it does appear, I think the consensus would agree, yes, we are in a cyclical slowdown, but we're not going into recession. And then you add on to that the argument about, that GDP revision, suggests that the economy wasn't that bad at all. Well, you do have to wonder whether or not the dollar can carry on declining on a build-up of Fed interest rate cuts speculation when there's already so much in the price. So, I'm of the view that the dollar is more inclined now to move on stronger than expected economic data than a weaker than expected data because so much Fed easing is in the price. But there is that caveat to that. There is still the credibility of the Fed issue. If the market does fear that the Fed could be losing its credibility perhaps into the start of next year, that could certainly be a negative factor for the US dollar.
And Jane, as always, we got to talk about currencies on a relative basis, right? So let's take the dollar versus the euro as one example. At a time when we've got a cutting cycle here in the US and not the same kind of trajectory in the EU, does that imply that in particular we could see euro strength?
Well, not necessarily, because it's so well priced in. Christine Lagarde at the last ECB meeting indicated that perhaps the ECB has finished with its easing cycle. That's Rabobank's view too, and we're certainly not alone in that view either. So yes, the ECB has probably stopped easing. The Fed has got more to go, but that's already in the price. So we would have to have a significant change in the economic data and the outlooks for both the Eurozone economy or the US economy to really shake up that view. So given that's what we've got, given that's what we've got in the price, you have to ask, well, the euro has rallied an awful lot this year. A lot of that because of the optimism about the change in Germany's fiscal break, about the optimism about what that could do, not just for the German economy, but for the Eurozone economy. But look at the German economic data that's coming through. It's not that great. Look at the IFO last week. It really wasn't that great. The market consensus for German growth this year is just 0.3%, which is not that great. And so bearing in mind the headwinds that the Eurozone economy has got in terms of relatively high energy prices, for instance, trade tariffs, a stronger exchange rate than it used to have. Well, I think it's going to be pretty tough, I think, for the euro to keep on going higher from current levels.
So, Jane, as we talk about two major currencies where we already know a lot or think we know a lot about the trajectory and a lot is in the price, as you look out over the next year, what's the big surprise that you expect? Or where in currency markets, where's the biggest dislocation and where you think there could be some opportunity?
Well, I mean, the biggest surprise would be if the dollar did not keep on weakening. And that's the market consensus. The market consensus for a while has been, looking at 120 and wondering how long it was going to take. That could be a lot further away than we think. And very much depends on the US economic data. Payrolls clearly in view for this week. That's going to be really important in this argument about, how slow is the US economy going to be this year or not. So that number is going to be, I think, really very important. But, aside from that, the yen, I think, is really interesting. The possibility that they may hike interest rates again, potentially in October, that's an interesting one. And sterling, very interesting. We've got that UK budget on the 26th of November, the Labour Party conference right now in the UK, and sterling, we think, is probably going to remain on the back foot because it's going to be so difficult for Rachel Reeves, the Chancellor, to get herself out of a position that she is really quite tightly boxed into.
Jane, thanks so much. Really appreciate your time this morning.
Thank you.
Coming up, full market coverage ahead in the second hour of Market Catalyst. Don't go anywhere. Coming up this hour on Market Catalyst, first up, as we enter the final days of the third quarter, we'll look at how seasonality will affect the fourth quarter. Plus, we dive into Carnival's latest results and what its earnings show about the U.S. consumer and the why behind the high. We'll dig into what's driving Western Digital shares as the company outperforms the majority of the S&P 500. 90 minutes into the start of U.S. trading, I'm Julie Hyman. Let's get a check of the markets here. We had been seeing a weak trading week, I should say, last week, especially for large cap tech, coming back to some extent today, especially on the tech side, where we see the NASDAQ up about 0.75%. The Dow, though, has remained in the red since early trading, down 40 points right now. The S&P 500 up about 0.4%. Western Digital, a maker of hard disk drives and data storage, one of the top performers on the S&P 500 this year. It's up over 150% year to date, and in the past quarter, it's risen over 80%. Shares hitting an intraday record after several analysts raised their price targets for the stock. One of them is going to join us now to talk about the why behind the high. That's Kevin Cassidy. He's Rosenblatt Securities Managing Director and Senior Research Analyst. Kevin, thanks for being here.
Hi, Julie. Thank you very much for inviting me.
So let's talk first of all about your note out today that raises your estimates for the company. You're looking at the backlog, you're looking at prices. What kind of changed in your view that has been such a tailwind for Western Digital?
Well, there's two big aspects of the change. One is all the AI data centers that are being announced and planned to be deployed over the next 2 years, maybe even 4 years. And all of the data centers need storage. And that's what Western Digital provides, is hard disk drives that offers the lowest cost mass storage of data in the world. So every data center needs lots of storage. The more data you have, the better your AI outcomes will be.
So Kevin, without getting too technical, let's break down for folks a little bit about what role hard disk drives play. Now, I know I got a hard disk drive in my computer, right, that provides storage. in most PCs, I guess all PCs, they have hard disk drives. When we're talking about the role that they're playing in a data center, what exactly do they do? What function do they serve?
Well, it is just storage of data. So maybe if you even use Yahoo Finance as an example, and all your videos that you have made, and you store it all in hard drives, that's the lowest cost. And you use that data to run algorithms, artificial intelligence algorithms, and maybe you can find out which of your shows gets the best ratings, or you can optimize what your shows would be. But the hard drive has to be used to store this tons of data.
I love the Yahoo Finance example. We'll have to use that going forward for all of our segments and real world examples. So you have a Western Digital, you have Seagate, which also provides hard disk drives, which has also done very, very well. Is this something where it's a tide lifting all boats with this AI demand and the build out of data centers?
Yes, it is. As you mentioned, your PC has a hard drive in it, or it used to be just about every PC had a hard drive in it. And over time, solid state drives, these are made of NAND flash, they use lower power. You can put more data in the same amount of space. So the solid state drives started replacing hard disk drives. So that was a headwind for both Seagate and Western Digital for their longer term growth. But now that, I would say 90% of PCs use solid state drives and not hard drives, they don't have that headwind anymore in revenue. And now it's only going into the cloud data centers, which giving them now revenue growth in 15% per year over the next 5 years. So they're experiencing new levels of growth, and they're also experiencing new levels of profitability. And that's what's really changed. And the market is now giving them a higher valuation for their profits because of the growth rate.
Is there any risk that you would see a migration in data centers like we saw in PCs?
Well, in a PC, you could only use so much data. Maybe 1 terabyte is probably plenty for most users. But in data centers, as I mentioned, they're trying to store every piece of data for companies. And a hard disk drive per bit is probably 8 times cheaper than a solid state drive. So we think the lower cost is going to win out in the longer term.
One of the things you talk about in your note on Western Digital is their sort of build to order strategy. In other words, they're not building in advance and hoping that people buy it, I assume is the way that this works. How does that give it an advantage?
Yeah, that helps you control your supply chain, and you don't end up with the cycles that we've seen so many times in the memory and storage industry. When you have 300 customers, you have to build for inventory, and you're never sure which one of your customers is going to have too much inventory, and it would cause a inventory digestion or a slowdown in revenue. Now there's only, we'll say, 10 customers that are dominating their orders for both Seagate and Western Digital. And if they can get a 12-month backlog, they can now control their supply chain more effectively. And that, again, helps gross margins go up when you have better control over your supply chain.
Kevin, we've already seen the stocks do really well. Whether you look at a Western Digital, whether you look at a Seagate, or for that matter, a Micron, whose chips go in to provide this memory and storage. How much of this outlook do you think is already priced in? How much upside do these stocks have?
Well, I think we're seeing it today. That I went back and looked at my model and said, if we have Oracle announcing $300 billion of new deployments and OpenAI getting a big investment from NVIDIA, then I was only looking at maybe 2 years from now 6 or 7% revenue growth, but now we're feeling a lot more comfortable that could even go up to 10% revenue growth based on all this new announcements. And we don't think that these announcements they have to be planned now, and getting the storage is part of that planning. So we think this is where the valuation metrics that you use goes up because you're more confident in their revenue over the next 2 years.
Well, and I guess if you're comparing them, I've talked to a lot of investors who say even NVIDIA is not necessarily overvalued because its earnings are rising along with its price. But if you look at these guys, I mean, at least on a pure PE basis, price to earnings basis, they're a lot cheaper than some of the other choices out there, right?
Yes, they are. But they're a lot more expensive than they have been historically. Again, when they had exposure to the PC market and was only growing 3 to 5%, and they had 30% gross margins, they traded around 10 times forward earnings. Now they're trading closer to 15 to 20 times because their top line is growing 15%, their gross margins are over 40%, and they have predictability in front of them. So the market is giving them higher, but a higher valuation, but nowhere close to NVIDIA that is, of course, running at 75% gross margin. And so they trade at 35 times forward earnings.
Right. So everything is relative, including to your own history, I guess. Kevin, thank you so much. Really appreciate it.
Yes, thank you.
Take care. Coming up, we'll have the outlook for the cruise industry after Carnival raised its profit guidance. Stay tuned. You're watching Market Catalysts. President Trump is targeting the film industry yet again. In a post on Truth Social, the president reiterated his call to impose a 100% tariff on films made outside of the U.S. There's some confusion as to how exactly that would work. Join us now to break it all down. Yahoo Finance's Allie Canal at the NASDAQ. So, Allie, how would it work?
That's the big question, Julie. No one knows much at this point, and we're not seeing a ton of reaction in media stocks either. And that could be because there are still a lot of unknowns around what a tariff on foreign-made movies would actually look like in practice, especially with no details on the timing or the scope. Now, Trump's post revives a proposal that he floated earlier this year when he argued that tariffs would help bring film production and jobs back to the U.S. But Hollywood insiders are warning that the fallout could be severe if it's implemented. Veteran producer Catherine Arnold told me back in May that the impact would be, quote, insane and devastating to the industry, likely driving up budgets and wiping out smaller films as studios lose access to lower cost international shoots. Separately, I also heard from longtime Hollywood executive Chris Fenton, who said that the uncertainty alone could slow down green lights or freeze projects entirely until studios know what qualifies as foreign. And at the same time, this was back when the idea was first floated in May. Morgan Stanley analyst Ben Swinburne cautioned that with just a single Truth Social post to go on, it's really impossible to size the impact, although he did say that a 100% tariff could ultimately mean fewer, more expensive films and possible retaliation abroad, especially for streamers like Netflix, which heavily rely on international content. Trump has appointed a trio of actors, Jon Voight, Sylvester Stallone, and Mel Gibson, as his special envoys to Hollywood. That's part of a broader effort to try and reshape the industry. But for now, though, markets are clearly waiting for more clarity. Hollywood producers, directors are also clearly waiting for more clarity, including whether any tariff would apply to streaming content or just theatrical. So, Julie, just a lot of wait and see moving parts here as we await to see if the president has any more clarity on this moving forward.
Yeah, especially as we have these other tariffs that are set to go into effect imminently as well. Allie, thank you. Now time for some of today's trending tickers. We are watching AppLovin, furniture stocks, and Moon Lake. First up is AppLovin. Those shares are jumping after a big price target increase. Morgan Stanley boosting its forecast for the shares to $750 from $480. The stock hitting a record high amid that upgrade. AppLovin is also seeing some tailwinds after gaining S&P 500 inclusion just last week. It is now up 123% this year. Next up, we got furniture stocks. They're under pressure again as President Trump threatens tariffs on companies that do not make their furniture in the U.S. That threat appears to build on Trump's plan announced last week to impose levies on foreign-made kitchen cabinets, bathroom vanities, and upholstered furniture. Those tariffs are set to go into effect on Wednesday. And we see a mixed picture for some of those furniture manufacturers. Williams-Sonoma also one of the stocks under pressure. And finally, we got Moon Lake, the immunotherapeutics company seeing shares plunge by the most on record. The drop follows disappointing late-stage clinical trial data for one of its experimental drugs. That decline taking shares to their lowest level since August of 2022 and wiping out $3.6 billion in market value. You can scan the QR code below to track the best and worst performing stocks with Yahoo Finance's trending tickers page. The IPO market has come roaring back this year with names like Circle, Klarna, Figma. They've all gone public in recent months. Yahoo Finance's Josh Lipton spoke to Dean Quiambo, Armanino partner and technology industry leader, about all of this.
The IPO window, Dean, does look open. Companies are taking the public market plunge. Why is it open, Dean? Walk me through the reasons.
Yeah, well, number one, you got to say that these companies, they're performing really well. Right? They've wanted to go IPO for a while. The IPO freeze is now unlocked, and now they want to go. Their backers, their investors, whether it's the PE funds or the VC funds that are behind them, want them to go. Their employees want them to go. And they have the financial results that validate that they should go. And then, on top of all of that, you have an insatiable market of companies and of people and of funds that want to invest in these companies.
Does it feel 2021-ish to you at all, or no?
No, I would not say that. It's
Why? How come?
Yeah, because today these companies are fundamentally strong. I think back in 2021, you think about it, there was a lot of, how would you say, selling the sizzle. And today it's, no, we're not just selling the sizzle, but look at our numbers. Our numbers are strong. We have strong unit economics.
There's some meat there.
That's put some steak on the plate. That's right.
Let me ask you, does this window stay open? What does that depend on? What are the variables that depends on?
Yeah, there's going to be some macroeconomic things there. Interest rates is one that we got to look at right now. Tariffs is another. I think after inauguration, everybody was so excited that the market was going to just rip with IPOs. And then we had Liberation Day.
Right, some uncertainty creeping in, yeah.
And then everything calmed down for a while. But now that everything's calmed down, now you see companies saying, hey, the window is open and we got to go. The reason for that as well is they might have missed the last window. So they want to go now, right? While their valuation is there and their numbers are there.
When you look at the companies going public, so Klarna and Circle and Corey and Figma, are there certain common trends and themes you can spot, Dean, that explain, okay, the success or not as successful in terms of debuts?
Yeah, that's right. You're going to look at profitability or path to profitability, those unit economics. You're going to see a growth story. They're all telling a very strong growth story. But more importantly, that they're going to say, hey, when we get these dollars, we can execute our growth story. Because they know if they can't execute on what they say they're going to do, they're going to be punished. They're going to be in that penalty box, and it's going to be hard to get out of there. So they really want to say, hey, are we able to forecast our revenue and our results for multiple quarters? As Armanino, we like to say, it's not just about going public, but it's about being a successful public company quarter after quarter after quarter. When companies can do that, all of a sudden you start to see that their market value starts to rise over time. It's not just going public, but how can we build that enterprise value over time? And what that's going to be is strong people, strong processes, and strong technology. If you can enable that, you've got a chance.
Do you need an AI story to go public right now?
I would say yes.
You would?
Yeah, I think I need. There's got to be something adjacent there. Now, there's going to be tech companies that obviously there's going to be a lot of companies that maybe they're not tech related. But if you're in tech, you've got to be AI or AI adjacent or have some story in there. And maybe that's even just how we're implementing AI and automation into our business, and it's increasing efficiency. Maybe we're getting margin gains by implementing AI into what we're doing.
If you're an investor and you're looking over that S1, how do I try to distinguish, Dean, between, okay, this company really has an AI story versus maybe it just sounds like marketing fluff? What would I be looking for?
Yeah, I think you're really, when you think about that, I think about a great example is Chime, right? When you looked at that, they said that they were able to answer 65% of their customer inquiries without using a person. They were able to automate that. So those are things that you're like, okay, they like to focus in a demographic that's under 100,000. They feel like people who make $100,000 or less are underserved, and they can automate responses and have a lot of touch with their customers, create that stickiness. That's a story that would resonate. Or maybe you can talk about Figma and say, oh, wow, in that Figma IPO that we all know about, well, they talked about there how they can expand within their client base, how they got really sticky, and that there's so many more services that they can expand into. And then how are they going to do that? Well, hopefully it's going to be a little bit of that AI platform, right? They're building a platform and a technology that their customers can easily do more.
You're living and working out in Silicon Valley. Would you say the AI trend and theme out there hot as ever versus like 6 months ago, or if I had asked you 12 months ago?
White hot.
What, really?
White hot. I just went to a AI Finance Summit the other day, and 1,000 CFOs tried to get into that summit. They can only take 150 people in the room.
That's remarkable.
So it is, AI is everywhere. The buzz in San Francisco and in the Valley is back, I tell you. The energy feels good.
Last question, what's the IPO on your radar? What's the name everybody's waiting for?
Yeah, the one that I think we're all waiting for next is Databricks.
Why that one?
Yeah, because I talk to a lot of CFOs. At Armanino, we work with a lot of CFOs that are bringing their organizations forward. And they're growing and scaling, and a lot of those organizations, those CFOs, they tell me they love their Databricks, right? And so when you see a company that a lot of people have been talking about for a long time, where their customers love the product, it's going to be exciting. It's going to be interesting to see what do their numbers look like, right? We all talk about the rule of 40 in public companies as they go, which is a gross margin and the growth rate. Does it equal 40 or not? It'll be interesting to see what that number looks like for Databricks. For Figma, it was 63. So.
When that S1 hits, we'll have you back. Thank you, Dean. Great to see you.
Thank you.
September was supposed to be the worst month of the year, and it's almost in the books, and it wasn't even that bad. Today, we're going to take a look forward to October, and we're going to be breaking down seasonality. So let's do that real quick here. Seasonality is the predictable and recurring changes in data that happen at about the same time every year. And we take a look at it sometimes a presidential cycle, it might be every 4 years, but the bottom line is we're looking for recurring patterns. And so let's start with this bar chart first that shows each month having a return, and this is just the median return since 1990. And the median is kind of like an average, except that it's not so skewed by large outliers or underliers there, to the upside or to the downside. And here's where we are right now. We're still at the end of September. As I mentioned, it was supposed to be the worst month of the year, but actually it was pretty good. And in fact, we were expecting the last 6-7 days to be all negative, and we got a few bouts of negativity in these days, and we still have 2 more closes to go. But nevertheless, we're probably going to close with some decent returns, at least in some of the indices. Now we can look forward to what is the most positive quarter of the year. And I'm going to be breaking this down in part tomorrow too, the fourth quarter. But today I just want to cover what's happening with October. And here's another look at the full year. In white is what has actually happened. And you're going to note here that this was a big post-Liberation Day sell-off and that quick recovery, which is one of the quickest returns to highs that we've ever seen in the market. And then I have 2 different models. One is a median since 1990. That's in green right here. And in blue, we have the median since 1928. And that is where each day of the week has to match what we are in presently. So if, for instance, it is Monday, September 29th, we just have to look at those Monday, September 29th throughout history, except we're mapping this into October. And you can see here real little that we did have this sell-off in the white line that kind of matched what we were expecting in that median since 1928, same day of the week. And that has actually become my preferred model. This has become a pretty good predictor of what's happening. So here we have that same model, median since 1928. And let me just trace out what we are expecting for the month of October. And you can see we rise pretty quickly in the early part of the month, and then we kind of drift lower into the end, but then we got a little bit of a bounce at the end. And we also have that other model, median since 1990. That more or less kind of revolves around the unchanged. It goes slightly negative in the middle of the month, and then delves into the positive towards the end. The point is, depending on how you slice and dice the data, you can come up with wildly different different models. And so I'm not trying to confuse people, but there are different ways to do this. And so you might see some different seasonality results from different people who are doing a lot of these studies. But again, my favorite here is median since 1928, same day of the week. And for that, we are expecting some outsized performance in October. Now I want to move on to a different market. This is the VIX, and in white we have the average VIX since 1990, which is when it began, and then in green we have what's happened this year. And the VIX responds to volatility, and it's looking forward to options changes, basically what the options market is saying about changes in the S&P 500. And what sticks out is this huge spike. That was a Liberation Day spike that we got there. And what you're going to notice is even though the model, the average drifts up into October, and that's when we've seen a lot of market crashes throughout history, we've seen muted volatility so far. So the potential is for volatility to rise. We just haven't seen it just yet. So to review here, we have performance leaning positive in October. Volatility tends to rise. Notwithstanding that, I also want to point out that we have more than average trading days. Usually it's 21. We're dealing with 23 here. And also for Indigenous Peoples Day on October 13th, stock markets are open. Bond markets are closed, and your bank is probably closed too. So having said that, tune in to the next Stocks in Translation podcast for more jargon-busting deep dives. New episodes can be found Tuesdays and Thursdays on Yahoo Finance's website or wherever you find your podcasts. Julie, back over to you in the studio.
Thank you, Jared. Appreciate it. Well, we've got some breaking news now. With the government shutdown looming in Washington, economic data could go on pause. If the government does shut down, the Bureau of Labor Statistics will halt operations. Joining us for more is our Washington correspondent, Ben Werschel. And Ben, there had been a little bit of a question about how this would play out. So explain to us what we now know.
For sure. So what was widely expected was that this shutdown would cause a cease in government data. And what the development in the last couple hours this morning is that is now confirmed. The Department of Labor has released what's called their contingency plan. Every department has to release that. And within that document, it does confirm that the Bureau of Labor Statistics will cease operations. It'll cease releasing economic data, and it'll cease gathering economic data. The first effect here will be Friday with the jobs report. That data is actually already it's already been gathered, but it won't be released on Friday if there's still a shutdown. That data is kind of in the preparation phase. It will extend, if this is a shutdown that extends longer, it'll affect other economic data. Another one to watch is inflation. That's actually, that's data that's gathered more on a regular basis, so gathering will cease there. And so we might not get inflation data, the consumer price index, in a few days' time if this government shutdown keeps going on. Overall, the Bureau of Labor Statistics will go from 2,055 employees, according to this document, to one full-time employee during the course of a lapse. So basically, the entire agency will be shut down during the course of a shutdown. It'll then reopen at the end. The question being how long it's going and how much data might be lost, especially, which could be an issue if we have a weeks-long shutdown in the weeks ahead.
Yeah, and Ben, we have had shutdowns before, obviously. Is there any way of trying to game out or figure out or what signs we should watch to see how long this will take?
Yeah, I mean, we'll get a big sign this afternoon. President Trump is scheduled to gather all four top congressional leaders, 2 Democrats and 2 Republicans, in the Oval Office. So that'll be a big sign as to sort of what path we're on here. I think the expectations are pretty low at the moment, that this is going to be kind of more of a shouting match than a real negotiation session, but we could see. We'll see. Right now it's closed to the press. I think if that goes and if that continues and we don't see these lawmakers talking immediately, that might be a good sign that they're actually negotiating. If they're in front of cameras yelling at each other, obviously that'll be a bad sign. The economic rule of thumb always, I just repeat, is length. A couple-day shutdown tends to kind of reverse itself and all things work out on the economic front. If we're a couple weeks' time and you still have me on talking about shutdown, then we're going to start seeing the economic effects, both the effects themselves and then the effects on this data start to have teeth.
Yeah, great point. And of course, the other big thing to point out is that there is a Federal Reserve meeting towards the end of October. And so this is something that they need those numbers to figure out what they're going to do next. Ben, thank you so much. And of course, we'll have more on the impacts of the government shutdown throughout the day, throughout the weeks if we need to, but also after the break. So stay tuned. A A partial government shutdown is just days away as lawmakers continue to debate a spending agreement. So we're taking a closer look at what a shutdown means for you and your money. Essential services will continue through a shutdown, including military, law enforcement, the Postal Service, the Federal Aviation Administration, and the Transportation Security Administration. But those workers will not be receiving paychecks. During past shutdowns, some TSA checkpoints were closed, and travelers faced longer lines when agents didn't show up for shifts. Non-essential services like national parks will close. In the past, some parks were kept open with state help, but with fewer visitor services, leading to reports of damages and trash pileups. The Smithsonian museums also typically close within a few days. As far as benefits, federal Medicare and Medicaid health insurance programs are considered mandatory spending. That means benefits will not be impacted. Social Security will also continue to be distributed, but staffing in some services could be affected and could cause slowdowns. As for SNAP benefits, they'll only be affected if the shutdown lasts for more than 30 days. That's because funding typically only allows the Agricultural Department to send out those benefits for 30 days after a shutdown begins. And when it comes to the market, stocks are typically pretty indifferent to shutdowns, with the S&P 500 rising more often than falling in the past. But it could have an impact on economic data, delaying key releases like the jobs report and CPI report. Well, about 6 million veterans accessed both the VA's health care as well as the compensation and pension programs in fiscal year 2023. A government shutdown would likely curtail those benefits. So how can vets access these services during a shutdown? Joining me now, Patrick Murphy from RGP Media LLC, also served as the 32nd Army Undersecretary in the Obama administration. Thanks so much for joining us, Patrick. It's good to see you. So what do we need to know about the numbers of people that might be affected by this shutdown?
Yeah, thanks, Julie. I appreciate that. You know, we cover this on our Yahoo Finance show, Warrior Money. The reality of it is there's over 18 million fellow veterans like myself across America. About 9 million of those, Julie, they'll get benefits from the VA, whether they're healthcare benefits or VA home loans or GI Bill, et cetera. So, you know, when you look at that and you also look at the active duty military, there's about 1.3 million on active military service that won't get a paycheck unless there's a deal cut. So, you know, it's really going to really hurt our brother and sister veterans and active military if there's not a deal cut within the next 48 hours.
Now, obviously, Patrick, you're a veteran. You talk to a lot of veterans. You know, we know that people will get their paychecks eventually, right? But how eventually is really important. How much cushion do these folks tend to have?
Yeah, usually it's paycheck to paycheck, Joey. I mean, I know you and I, we talk about this around the office at Yahoo about, you know, that Dave Ramsey, you know, have 3 months of emergency funds. But the reality of it is this is the fourth government shutdown under the watch of President Trump. The last one 6 years ago in 2019, that shutdown lasted 34 days. So imagine going a month without a paycheck. For a lot of these families that already aren't making a lot of money, again, that's a lot. And I know you mentioned the Bureau of Statistics, you mentioned TSA agents, but those 1.3 million on active duty, but also those, you know, veterans that, you know, might need help and they can't get help if, you know, the VA, you know, isn't there to be helpful, especially when you look at, you know, tomorrow is September 30th. It's the end of Suicide Prevention Month. So when you look at veterans are more likely to take their own life, die by suicide, we have lost over 120,000 veterans to suicide since 9/11. So we got to do all we can to make sure we're supporting our brothers and sister veterans and our active military.
When you look at who's tapping these benefits here, it's a lot of folks too. There is a little disparity in terms of age and gender. So talk to me a little bit about that and what the implications of that are.
Yeah, there's older veterans that use it, and you know, a lot are in a Vietnam, you know, generation. I had 2 uncles that served in Vietnam. I'm named as a Vietnam veteran. But when you look at female veterans that are using the VA, they tend to be younger in their 40s, and are frankly my generation of what we call post 9/11 veterans. You know, I served in the invasion of Iraq, et cetera, and did 2 combat deployments. But you know, when you look at, you know, our military is more diverse, more women, and so more women are now using the VA for healthcare or using it for benefits. And so, you know, when you shut down a government, And again, I'm hopeful for the meeting today. You know, I'm a former congressional appropriator. I'm glad that the meeting today is close press. So hopefully the top four can really try and figure out a way forward. But when I think about how it's going to skew and hurt more female veterans of my generation, it breaks my heart, and especially at a time when we have high rate of suicides and we got to do a lot better job.
Patrick, I'm also curious, as you mentioned, you were also in Congress. The Democrats seem to be pushing for an extension of ACA and not seeing the kind of healthcare funding cuts that the administration and the GOP have pushed for. How many veterans tap into, just that kind of insurance as well? Are they entirely covered by VA benefits, or do some of them also use those other types of health insurances?
Yeah, I mean, like you look at a lot use it. I mean, most of the veterans aren't using, the VA for healthcare. About over 6 million of the 18 million use the VHA, Veterans Healthcare. So most are like me. Like last year, I used Penny here in Pennsylvania, and Penny, which again is under the ACA, you get some premiums and some support, especially if you're middle class or lower middle class. The reality of it is, though, Julie, that the premiums in the subsidies are going to double or triple this January 1st. So we actually have a lot of Republicans that are saying, hey, Mr. President, let's come together. So let's do a year extension or a 2-year extension. You have people like Senator Lisa Murkowski from Alaska who's saying, let's do a 2-year extension on these healthcare premiums, because what we don't want during these times is for people not to have health insurance, the people to go back and not be covered, not going in. And, when they get sick, then they're going to go into the emergency room, and it's going to jack up prices for all of us.
Patrick, good to see you. Thanks a lot for joining us. And of course, you can tune into the Warrior Money podcast Mondays at 3 p.m. Eastern to talk about all of these issues and much more. That's it now for Market Catalyst. I'm Julie Hyman. Thanks for watching. We got more Yahoo Finance coming up.